Good morning, everyone. Can I please ask everyone to take a seat? We're about to start live. Thank you very much. Good morning, everyone, and welcome to the 2024 AASB Research Forum in the beautiful Sydney, and to everyone who is joining us online around the world. I'm Al from the Australian Accounting Standard Board. I'm a senior manager there and filling in for our research director, Eric Lee, who is the driving force behind today's forum, but unfortunately, he won't be able to join us in person because he's unwell. And I promised I wouldn't compromise the quality of today's discussion. And it's such a fantastic to see a diverse group of academics, professionals, thought leaders, and international standard setters all gathered here to what promised to be engaging and insightful events. So before we start, I would like to go over a few house rules. So in an event of any emergency, please follow the direction of staff. The assembly point will be outside the QVC building across the road. And the bathrooms are just located outside these doors to your left. And we will be using the Pigeonhole Live app for any of the questions. So the QR code for the Pigeonhole are available in the room, and we will show it on the projector later as well. So you're highly encouraged to search through any of the questions you would like to ask our panelists or speakers today at any point. And also for those here in person, please ensure your mobile phones are on silent. And additionally, I would just like to remind everyone that the views expressed by the speakers today are of their own, which does not necessarily represent the official positions of their affiliated organizations. So thank you again for joining us, and we are excited to dive into a full day of thought-provoking discussion. It is now my great pleasure to welcome the chair of AASB, Dr. Keith Kendall, to deliver opening remarks and officially kick off the forum for today. Welcome, Keith.
Thank you, Al, and good morning, everyone. It's really terrific to see everyone here in a very well-attended research forum. Breaking things already. So this is our flagship research event, and for those of you that have been following the work of the AASB over the last few years, you'll have an appreciation about the importance that we place on research, even more so than in days gone by. We have what I'd like to think is a particularly good relationship with the academic community, not only in Australia, but internationally as well. It's growing quite a lot. And this ties in very much with the work of the AASB in that our standard setting processes are explicitly designed to be evidence-based. And so academic research is at the forefront of that element of our work and our processes. It's best practice without question, and academics and the research produced is critical to that. We're very supportive of the academic community, and we're really making a big effort to instill a research culture within the AASB. I was just talking yesterday and we worked out we've now got 5 PhDs on staff, well, I'm not going to claim to be the most in the world. We've got a few different international standard setters here, so we're not, I don't want to be corrected, certainly not on the spot in case it's not, but there's a suspicion that that's probably the highest proportion of PhDs that any standard setter's got on staff, and if nothing else is reflective of the importance that we place on academic research and research in general. And of course, there's a number of you that have been in Sydney for this week. We're coming off the back of the AASB's Research Forum, which was held at the University of Sydney. And our first speaker, Professor Sue Wright, conducted that event there, being hosted, very important with that. So the University of Sydney did very well with that one, and so this is a continuation of that and pushing through with the AASB's involvement with the research community. So we have a number of papers that we're looking forward to today and a number of distinguished speakers. So I've just mentioned Professor Wright, who'll be producing the opening remarks. We're very privileged to have FASB board member Christine Bodison, who's come all the way from the US to speak with us today. As well as distinguished panellists, we're also going to be hearing towards the end of the day from Linda Mezen-Hutter and Professor Antaka, both on the AASB, which we're very much looking forward to. None of you came here to hear me speak for very long, so I will pull up there and introduce Professor Wright.
Thanks very much for those words of introduction, Keith. Well, good morning, distinguished guests, esteemed colleagues and friends. It is my great pleasure, on behalf of the UTS Business School, to welcome you all to the AASB Research Forum for 2024, well known as a premium gathering dedicated to the exploration and advancement of Australian accounting standards and academic research. Just speaking about UTS for a few minutes, I'm very proud to support a team of impressive researchers in the accounting department at the UTS Business School as the head of department. My colleagues at UTS are well known for their dedication to excellence in this field. The accounting department has a stellar reputation, consistently publishing in top international and Australian journals. And my colleagues' research covers a wide range of topics, many of which we will be investigating over the conversations today, but as well as financial reporting and standard setting, we also research corporate governance, auditing, management accounting and accounting information systems. We're also a hub of exciting research events. We host an annual conference, a robust and high quality weekly seminar program, regular visitors who engage with us with their research, and we really also value the interactions we have with practitioners who are keen supporters of our rigorous curriculum and who partner with us to develop graduates that are sought after in industry and the profession. And as I look around the room, I see a number of practitioners as well as academic friends here, and I know that we're going to be doing more of that today, that engagement between academia and practice, which really enriches us all. So the theme of the forum today is accounting and reporting in changing times. We certainly are living in changing times, and it's really exciting to have such expert speakers as is on the agenda for today to guide us through and challenge us and to help us think well about the issues that face us. I would like to follow Keith in welcoming those who've participated in the AASB Research Forum 2024 over the last 2 days. I think we possibly deserve a gold medal for perseverance, but also it's wonderful that we've started those great conversations about issues concerned with reporting and standard setting and conversations that we'll be able to continue here today. So the key themes from today, and if you've looked at the program, you'll know what they are. The topics we're looking forward to discussing today with a format that involves a presentation by a key expert in the area, followed by a panel session that really pulls apart and explores the many issues. The topics that we'll be looking at in that setting include the Conceptual Framework, one that I'm particularly looking forward to after a short conversation with Christine this morning. And so, I mean, my thoughts are that it may be questioning whether the Conceptual Framework is robust and relevant to guide accounting standards and practice for the future, but time will tell as to whether that is the direction in which she takes us. But we're spending time also later this morning looking at goodwill impairment testing, followed by the afternoon of looking at nature disclosures and a very interesting reflection on 20 years of IFRS in Australia. So throughout the conference, I encourage you to engage actively and to share your insights and diverse perspectives. That way we will all end the day much richer in our thinking and our understanding. We have a wonderful opportunity to learn from each other, challenge our perspectives and contribute to the advancement of accounting standards and practices. So once again, welcome, and I look forward to the stimulating discussions and fruitful exchanges that lie ahead. Thank you.
Thank you very much, Keith, and thanks very much, Sue. So as we move forward with today's proceeding, now it's time for the much anticipated keynote speech from Professor Christine Bottison. So Professor Bottison is a member of the Financial Accounting Standard Board in the US, and before joining FASB in 2016, Professor Bottison has a distinguished academic career as a professor of accounting at the University of Utah. She is an award-winning professor and researcher who has a broad knowledge of accounting issues with expertise in financial statement analysis and valuation. And Professor Bottison also served as the president of American Accounting Association from 2014 to 2015. So today we are very privileged to have her to address the topic. The conceptual framework is vital, but is it up to the task? Please join me in welcoming Professor Bottison to the stage.
Good morning, everybody. I'm just so pleased to be with you today to share some thoughts on a very important topic, the conceptual framework for financial reporting. But before I begin, I do have to provide my standard disclaimer, which is that the views that I'll express today are my own because official positions of the FASB are reached only after extensive due process and deliberation. All right, so let's begin with missed a slide already. I'm going to begin by addressing why using a conceptual framework for financial reporting is essential to high quality accounting standard setting. And then I'm going to share my fear that our existing conceptual frameworks are inadequate to the task. And then finally, I'll illustrate the application of a new framework that's derived from economic principles to one of the thornier issues in financial reporting, which is the financial reporting for liabilities and equity. So let's begin with what a conceptual framework is supposed to be, which is a coherent system that prescribes the purpose of financial reporting and the nature of the financial reporting information that achieves that purpose. Now, the quote that you see on the slide is actually from FASB's conceptual framework, but it applies equally well to the AASB's framework. And I've highlighted the words coherent and system and interrelated because I wanted to emphasize that all aspects of the conceptual framework are supposed to work together in an internally consistent system. The FASB and the IASB's conceptual frameworks share the same basic structure. They start with a stated objective of financial reporting, which roughly is to provide information that is useful in making financial capital allocation decisions. And any coherent framework has to start with a statement of the purpose of financial reporting, because until we specify what it is that financial reports are intended to do, we can't sensibly determine what financial reports should include. But the real meat of the conceptual framework are the bubbles, the elements, the principles that lie around that stated objective of financial reporting. Those bubbles represent the tools that standard setters are supposed to use to develop accounting standards, which includes the definitions of the elements such as assets, liabilities, equity, and so on, that help board members determine what items belong in financial statements and where, as well as the principles that help board members determine how those items should be measured, when they should be recognized, when they should be de-recognized, how they should be presented, what additional disclosures should be required, and what the boundary of the reporting entity is for which the financial statements are being prepared. So the conceptual framework is really a decision-making tool that exists to help standard setters set high-quality accounting standards. which when applied by companies produce financial reports that achieve the objective of providing investors with decision useful information. That's why there's a green arrow that goes from bullet point 3, standards, back to bullet point 1, objective of financial reporting. Again, the entire thing is intended to operate as an internally consistent system from the objective to the principles to the standards and back to the objective. Now, why do standard setters need to use this decision-making tool? To explain, let's visualize the objective of financial reporting to provide information that is useful in making resource allocation decisions as a destination on a map. And the principles, such as the element definitions, the measurement principles, the recognition principles, and so forth, are the roadmap that standard setters should follow when attempting to move accounting practice from where it is currently to where it needs to be in order to meet the objective of financial reporting. Now, agreeing on the destination and following the roadmap increases the likelihood that a majority of board members will reach consensus. In addition, board members and staff members come and go. Having the conceptual framework helps to support the creation of standards that consistently hit the intended target with that characteristic of the organization. Also, stakeholders that understand the framework can better understand the standards that we set, but also better question us in terms of whether or not the standards we are setting are as they should be. And finally, a robust conceptual framework protects the independence of standard setting by providing the board with a shield to buttress against the undue influence of special interests. And we all know what happens to standard setters that operate without a robust conceptual framework. The Committee on Accounting Procedure, the Accounting Principles Board, and the International Accounting Standards Committee all were disbanded amid criticism that they failed to resist pressure from special interests and did not adequately improve financial reporting for investors. Well, following a conceptual framework, therefore, is essential to the effectiveness of accounting standards and to the endurance of private sector standard setting. But are the standard setters' current frameworks up to the task? If yes, then why is it that we continue to struggle with many of the same problems today that we did 80 years ago? Problems like improving the structure and articulation of financial statements, improving the statement of cash flows, and addressing the accounting for business combinations and goodwill, intangible assets, and the financial reporting of liabilities and equity. And that's just to name a few examples. So I believe that if we had a more complete and well-structured toolkit, we would be in a better position to resolve these and other tough, long-standing financial reporting problems. And in my personal experience as a standard setter, I have also found our existing toolkit to be lacking when I'm sitting at the board table trying to make decisions. Rather than driving consensus, our framework too often drives debate. It suffers from internal inconsistencies and significant gaps that limit its usefulness. Now, as an academic, I crave structure in decision-making, and as a board member, out of need, I built a more complete, internally consistent framework derived from a set of economic assumptions about the world in which financial reports are produced and consumed. The slide that you see now, which don't try to read the little tiny print, it's just there for illustrative purposes. This slide provides an overview of that framework that I've constructed. And I call it the deduced framework because it is deduced from 21 economic assumptions about the objective of financial reporting, the environment in which financial reports are used, who uses financial reports and for what purpose, the model, the nature of risk adjustment, and the nature of cash flows that are employed in valuation, and assumptions about the financial reports themselves. The principles that are deduced from those economic assumptions include the definitions of asset, liability, equity, and comprehensive income, and a principle that delineates the boundary of the reporting enterprise, as well as sets of measurement principles, recognition and derecognition principles, and presentation and disclosure principles. So in my remaining time today, what I'll do is provide a high-level peek into how some of the definitional and measurement principles that are in this deduced framework could help standard setters think through the financial reporting for liabilities and equity, including deciding which items should be classified as liabilities, which should be classified as equity and why, how liabilities should be measured and why, what changes in liability measurement should be included in comprehensive income and why, and how those decisions would support the objective of providing investors with decision-useful information. So let's start with the first standard setting question of what types of claims go in which buckets. Now, to help answer that question, standard setters should turn to the definitions of liability and equity in their conceptual frameworks. The FASB defines a liability as a present obligation of an entity to transfer an economic benefit, and we define equity as the residual interest in assets that remain after deducting liabilities. Now, I'd like to point out that that definition of equity is not the definition of a particular type of claim in the equity section. It is a definition of the equity section itself, which is not helpful. And the two definitions together, I have found to be severely limited in their usefulness in helping me answer the question, which buckets should various types of claims go in? Because the definitions are unclear as to what attribute of claims distinguishes a liability from an equity. For example, is it the form of settlement, such as cash or equity? Is it the timing of settlement, such as a perpetual claim versus a non-perpetual claim? Is it whether the value of the claim is indexed to the value of the entity or not? Because the essential characteristics that distinguish liability claims from equity claims are unclear from the definitions, we have been inconsistent across standards in distinguishing liabilities from equity. Sometimes we focus on whether the claim is settled in cash or equity, for example, stock options. Sometimes we focus on whether a claim is perpetual or not, for example, preferred stock that is or is not mandatorily redeemable. Sometimes we focus on whether the value of the claim is indexed to stock price, and sometimes we try to use a combination of attributes to determine what should be a liability and what should be an equity. But using more than one attribute is not operable. It is simply impossible to consistently separate items between two buckets using more than one attribute. So, to get help with an answer to the question of which buckets, I will turn to the definitions of liability and equity claims in my deduced framework. Those definitions and the definition of an asset are deduced from the economic balance sheet that the accounting balance sheet is a practical representation of. The balance sheet equation for the economic balance sheet states that the value of an entity's economic resources, or equivalently, the value of the entity, equals the value of the claims against those economic resources. This equation is always true because of the existence of the residual claimant. That is the individual who always just gets what's left of entity value after the non-residual claimants have gotten their piece of the company. Consequently, the claims against an entity's economic resources can be split into two buckets: non-residual claims that don't depend on the value of the entity, and residual claims that do depend on the value of the entity. Now, the deduced definitions of assets, liability claims, and equity claims are derived directly from their economic balance sheet counterparts. As a result, an asset is defined as a present economic resource controlled by the entity, and I'll refer to that as definition D1. A liability claim is defined as a present, non-residual, or exogenous claim against assets as defined by D1, where exogenous simply means that the value of the claim does not depend on the value of the entity. And an equity claim is defined as a present, residual, or endogenous claim against assets as defined by D1, where endogenous simply means that the value of the claim depends on the value of the entity. The deduced definitions for, I wonder if there's like election news coming up. No. I have to admit, I've got it on my phone. I can track it as it comes in. So if you see me paying attention to my phone, that's why. All right. So the deduced definitions for liability claims and equity claims provide support for only one distinguishing characteristic between liability and equity, and that is whether the value of the claim is or is not indexed to stock price. Now, that is the sole attribute that I would use to distinguish a non-residual claim from a residual claim. Now, that is not to say that form and timing of settlement don't matter. They matter a lot to assessing solvency and liquidity. But there are other mechanisms that we can use to communicate that information, including presentation and disclosure. So while I won't talk about my disclosure and presentation principles today, rest assured they exist, and those that exist would ensure that information about form and timing of settlement would be communicated via presentation and disclosure. So the next standard setting question, once we figure out what buckets the items go in, is which measurement basis should be applied to liability claims. To get help in answering that question, I will turn to the deduced measurement principles for liabilities. Those measurement principles are derived again from the underlying economic balance sheet, but also from an analysis of the information that financial capital providers need to determine the value of their claims. Now, as we saw on the last slide, the economic balance sheet equation states that the value of an entity's economic resources, or equivalently, the value of the entity, equals the value of the non-residual claims plus the value of the residual claims. On this slide, that equation is written to solve for the value of the residual claims, which is equal to the value of the entity minus the value of the non-residual claims. Both types of claimants, residual and non-residual, are going to seek information that is relevant to the value of their claims. Accordingly, both are going to need information about the cash flows to the entity, which is why the deduced measurement principles for assets, which I don't have time to cover today, but they are designed to provide information that helps investors forecast cash flows to the entity. But equity claimants also need information about the estimated value of the liability claims, because in the absence of that information, the equity claimants face one equation and two unknowns. And if we remember anything from algebra, that's not a good place to be if you're a residual claimant. So the measurement objective for liabilities is to plug that informational hole, which is why the measurement basis for a liability is the value of the claim against the value of the entity. And depending on the nature of the claim, that value may be fair value, but it may also be an entity-specific value. Now, in either case, the measurement of liabilities is going to change over time. And so that gives rise to the final standard setting question that I'll address today, which is what amount of the periodic change in the measurement of a liability should be included in comprehensive income. The value of a liability claim can change because the cash flow that the liability will consume changes, but it is also possible that the value of a liability claim can change due to a change in the risk-adjusted discount rate, even when the amount of cash flow that the liability will consume doesn't change at all. Now, under the existing FASB and IASB frameworks, that doesn't matter to the measurement of comprehensive income, because comprehensive income is defined by a formula that forces all changes in measurement of liabilities, excluding transactions from owners, through comprehensive income. For example, the FASB defines comprehensive income as all changes in equity during a period except those from owner sources. Now, as standard setters know, the application of this definition creates problems. For example, the FASB issued ASU 2016-01 to require that the change in fair value due to a change in instrument-specific credit risk of a liability that an entity elects to measure using the fair value option be recognized in other comprehensive income. Unfortunately, as the FASB acknowledges in its framework, there is no conceptual basis for the existence or use of OCI. In other words, there is no conceptual basis for excluding that portion of the change from income. So why did the FASB decide to stick that piece of the change in OCI? Because, as explained in the basis for conclusions, preparers often have to disclose the amount of fair value change related to instrument-specific credit risk in separate investor packages in response to the fact that users often remove those amounts from net income because to them the amounts do not provide decision-useful information. Now, this is just one example of where the board has had to choose between following its conceptual framework or listening to investors' needs. In a framework that is structured to meet investors' needs, that choice should never be necessary. And that is not a choice that would be required by application of the deduced definition of comprehensive income, because the definition of comprehensive income in the deduced framework is not a formula based on the basic accounting equation that forces all changes in measurement of assets and liabilities through comprehensive income. Instead, the deduced definition is derived from the concept of economic income, and it defines comprehensive income as a change in an entity's cumulative lifetime cash flow, excluding transactions with equity claimants as defined by D3. Now, that definition provides the conceptual basis for limiting comprehensive income to only those changes in the measurement of liability that correspond to a change in the cash flow consumed by the liability. And it provides a conceptual basis for excluding from comprehensive income any changes in the measurement of a liability that don't correspond to a change in cash flow, such as a change in the discount rate, which has no impact on contractual cash flows. Now, clearly, the balance sheet still needs to balance. So we need to have a spot in the equity section to put what I'll refer to as balancing adjustments when the measurement of a liability or asset is done for a particular reason, but it creates changes in measurements that don't meet the definition of comprehensive income. So in summary, a robust conceptual framework that is powerful enough to drive consensus among board members and consistency across standards that produce financial reports that provide investors with decision-useful information is vital to the effectiveness of accounting standards and the long-term health of standard setting in the private sector. I have tried to argue today And it's been my experience that a record of difficulty addressing long-standing problems in financial reporting and my personal experience as a standard setter indicate that the standard setter's current frameworks are not adequate. And finally, a stronger framework like the deduced framework could help standard setters solve the unsolvable problems in financial reporting. So my presentation today has just touched on a fraction of the principles that are included in the deduced framework. I would be happy to chat further about the framework. In fact, my husband would say, if you get me started, you can't get me stopped. I would be happy to talk about the framework, the application of its principles to other financial reporting problems, such as the structure of financial statements, the statement of cash flow, the financial reporting for internally and externally generated intangible items, business combinations, goodwill, and other topics of interest. So if you would like to continue the discussion, please feel free to email me anytime at cvodison@fasb.org, and we can arrange time to talk. Thank you.
It will be question coming to you later. Yeah. Thanks very much for Professor Bodison for such a insightful discussion. I'm pretty sure there are questions from the audience in person and also online. If you do have any question, please use the QR code on the screen or scan the printout copy to send through your question. We will continue the discussion. We won't just stop there. So we are moving into the panel discussion session now. And we are very, very fortunate to have a truly exceptional group of experts with us today. Not only we have Professor Bodison from FASB, we have another 3 international standard setters here today joining us in the panel. And so firstly, I would like to invite Anne McGeehan onto the stage. Anne is a technical principal at the International Accounting Standard Boards with over 20 years experience in standard setting. And Anne has been working on the primary financial statement project in the past 4 years. Welcome, Anne.
Thank you.
And second, I will invite Pauline Wallace onto the stage. So Pauline is the inaugural chair of the UK Accounting Standards Endorsement Board. Pauline has extensive experience in accounting practice, public policy, and standard setting. And we also have Professor Han Yi from the Korea Accounting Institute. So Han is a distinguished professor of the accounting at, distinguished professor of accounting at Korea University. And he is currently on leave to serve as the CEO of Korean Accounting Institute and also the chair of both Korean Accounting Standard Boards and the Korean Sustainability Standards Board. And last but certainly not least, we have Amir Genda join the panel as well. So Amir is a reporting and assurance leader at the Chartered Accountants Australia and New Zealand. So although Amir is not a standard setter by profession, his extensive knowledge and experience with conceptual frameworks and the practical implications of the conceptual framework will surely add valuable insights to our discussion. And I would also like to acknowledge the chair of the Japan Accounting Standard Board is also with us in the audience today. So the session will be chaired by the chair of AASB, Dr. Kiskindo. All yours. Thank you.
Over here. Keith.
Thank you, Al, and welcome to our very distinguished panel. It really is a privilege to have a panel of this eminence being able to address a AASB event. We're very grateful that you're all able to be here. Now, I might just start off the questions. The way this will work is we'll generally take questions from the audience, but I might kick things off with one of the questions just to get things started. I won't pick on anyone in particular, so jump in whoever wants to address this first, and everyone will have a chance. But considering rapidly evolving business models and economic environments, in your view, how relevant is the current conceptual framework and what areas might need reconsideration? Christine, did you want to start or?
Sure.
Sure.
Is that it's automatically on? Excellent. So I think that the objective of financial reporting is robust to these changes that we're observing, these rapid changes. I do worry that some of, for example, definitions of elements are going to get more and more challenged with some of the new types of transactions and that we see. Because take the definition of an asset as an example. So it's a present right to an economic benefit. We already have many, many debates about whether or not something gives rise to a right. And I worry, as you know, some of these intangible assets that are created have less sort of legal rights around them. It'll become more challenging for us to apply those definitions.
Pauline, you look like you're about to burst.
No, I was absolutely fascinated, Christine, on your discussion just now. We've had the benefit of some discussions on this in the past, and I've always valued them. I worry a little bit about over-focusing on a conceptual framework. I mean, I think it's hugely important. I think understanding the principles that underpin financial statements is vital. But I think sometimes we blame the conceptual framework when the accounting is wrong, without actually thinking about why we believe the accounting is wrong.
Mm-hmm.
And that's where all the external factors, and particularly political pressures that come in, I think that's particularly relevant from an international perspective. So I think it's rash to say, well, the conceptual framework is inevitably wrong because we haven't got the answers we want. Because I think firstly, we need to challenge why we don't like the answers we've got.
Mm-hmm.
And I was thinking, so I loved your explanation of liabilities and equity, which has been a fascination of mine for many years. Very sad. But I think if I go back to thinking about all the debates that I had, the reasons we've never been able to solve the problem is because nobody liked the answer they got. And I'm not sure they'd like your answer any more than they like the answers they've got now. And I guess we have to recognize that we work in the real world, and we have to get users, not just the very sophisticated users, but all users to feel comfortable with the numbers that they've got. When an investor tells me they make too many adjustments to standards, to accounts, I think there must be something wrong with their model as well as the accounts themselves. And I also think we need to allow users to take that advantage that they have, their competitive advantage of taking the information they've got and then adjusting it. So I worry about too much looking at the economic value. Having said that, there are some areas of the conceptual framework, and I'm only really familiar with the AASB one, that I think do need to change, but more because the answers we're getting, even when you look at the conceptual framework, seem to be bizarre. And certainly measurement would be one of the ones that I would like the AASB to be taking a more close look at, because I am concerned that we haven't yet got sufficient focus between the value, for example, of assets in use compared with the value of assets that are held for sale. So there's a lot of work I think that could be done, but I'm undoubtedly be glad to know that I'm not asking her to do it, because I think there are probably more important things to use, but that's sort of where I am at the moment on the framework.
Terrific. Did anyone have Anne?
Just to say, Christine, I really enjoyed your presentation, and thank you. And I do agree, so obviously, that I think a conceptual framework is vital, but I think I have maybe slightly lower expectations of it. The way that the IFRS framework is set out is we have, I would argue, we've got two chapters at the beginning that talk about the objective and the characteristics of useful information, which I think are pretty solid. And then we move on to think about the definitions of assets and liabilities. I actually think our definition of an asset is pretty solid. I think it works and it works well. when we were revising the conceptual framework that came out in 2018, we knowingly didn't try to come up with a definition of a liability that really addressed the distinction between debt and equity. We had another project. We still have another project that is trying to work on that. So we sort of knew we were ducking that. So I agree. I think there are problems there. But then our recognition and measurement chapters, they very much take the view that this is a framework for making decisions. The framework itself does not give you the answers, but it establishes the way we would want the board to think about the question and therefore come up with the answers. So we don't have like bright lines for recognize when you do this, don't recognize in these situations, or measure it this way if that, measure it if another way if not. And it ties back, you were talking about it being internally consistent, and I think that's one of the good things about our framework is it takes these ideas of these qualitative characteristics of information, useful information, and says when you're thinking about recognition, that's what you need to think about. And then it explains how you might think about that in terms of recognition, how you might think about that in terms of measurement. So there are difficult questions out there. And I don't feel that that the framework is failing because we still find them difficult, because I think the framework provides a good framework for trying to come to the answers. I would personally agree that measurements, I really like your measurement chapter. Ours, I think it's good. It's got a lot of information in there. I wish we had to, this is definitely me personally. I mean, I won't look at my board members while I say this. I wish we had got a bit more into the ideas of entry and exit values in our chapter on measurement, but for whatever reason we didn't. So I agree. I think we could do more with the measurement chapter.
Mia?
Yeah, I read a book not that long ago that actually changed the way I think about this a bit. I certainly think the current circumstances, the amount of change, the dynamic situation in business and users of the information make the conceptual framework more important than ever. But the book I'm talking about, we're doing a little bit of work at CANZ on strategy at the moment. And I came across this book by Simon Sinek called Start With Why. I'm sure many in the audience are probably familiar with, maybe not. It's talking about the importance of having clarity on why for organizations. And I think you can actually extend it to professions and also to an activity like reporting. And for me, the conceptual framework contains the why. And there's a diagram in that book, The Golden Circle, which has why, how, and what. So I think the conceptual framework is our why. Why do we do this? And it's very much the objective, totally rooted right now in financial capital providers. It also gives us the how, which is how we go about actually achieving that objective. And I would see the standards as the what. The problem with starting with what is, and you could got some great examples of this in organizations. Compare Apple to something like Nokia. Apple has a very clear why statement. They make beautiful things. They don't make beautiful phones. They don't make iPads, except they don't make really fast phones. They make beautiful things. Compare that to Nokia, who are making really fast gadgets. And you've only got to look at the sort of exit speech at that famous press conference when Nokia sadly fell out of existence in that race. I think we're in a similar race right now when it comes to the legitimacy of reporting, not just financial reporting, but I'm sure later on we'll get onto non-financial reporting. But I do think that the framework is being very stretched, and I think there are instances where we've tried to pretend that we have clarity on the why, that this is all about financial capital providers, when increasingly, and not taking a view either way, but increasingly other capital providers, whether that's natural capital or other forms of capital, are pulling reporting into various different directions. So I think it's essential to go back and really try to gain as much clarity as possible on the why, and then have a discipline around the how we actually go about achieving that in the conceptual framework.
Did you want to say anything, Han, or
Oh.
we can move on? No?
Okay,
Well, you're lucky last.
so in 1972, when Stephen Penman, a world-renowned accounting professor at Columbia, left the University of Western Australia for Columbia, he said, asked like, "Oh, you're doing a PhD in what in the US? Accounting. Oh, then US colleges must have a PhD degree in plumbing." So what my point is, in class, I teach to students that accounting is a science of measuring wealth and value creation. It has coherent system, and as professors, we love this conceptual framework. But accounting originated from practices, and beautiful conceptual framework shouldn't be an obstacle in advancing in practices. For example, I don't know whether Trump wins or Harris wins as of now, but if Trump wins, stable coin, okay, will be legitimate. Now, stable coin as of now is backed by one-to-one real assets. It's more like cash. But under current conceptual framework, if we go back to 1960s, APB's definition of asset, for example, it could be an asset, nice asset. As of now, it falls into the intangibles category, but we will never put it in the cash and cash equivalents, although it's identical to cash and cash equivalents. So shouldn't the conceptual framework an obstacle in moving forward in practices? I don't know. So my point is, conceptual framework is important. We should write it very carefully, but it's ex post justification of what's already there, right? So it's a design choice. We should write it very clearly, but we should need to adapt to a new environment. For example, let me use a car analogy. Car makers produce a lot of cars, buses, passenger cars, SUVs, and then they can create this design blueprint or design principles. Oh, driver should be primary user. Passengers a secondary user. The car must be fuel efficient, but also it should be safe. Something like primary qualitative characteristics things. But then drone comes, okay? Elements like a combustion engine, metal sheets, tires. In drone, there's nothing like that. So should we change the design blueprint? Changing design blueprint won't solve any problem. So the point I'm trying to do is making is sustainability. So the last question in the prepared package, the last question was, should we adapt conceptual framework in addressing like sustainable reporting? Well, probably no, not in the US, because it's so different animal. It's like a drone, right? But in Europe, especially when you use double materiality, the audiences are changing, everything's changing. Probably you need to rewrite the conceptual framework. But would you do that? Probably not. It's about who you are. Who are we, right? But the problem is sometimes we don't know who we are. So, point. Conceptual framework is a man-made thing. It's a design choice. So it's a good thing. We should have it. But it shouldn't be an obstacle in moving forward in practices. That's my point.
So
You want to write a reply?
I would like to
Okay,
reply
yeah,
to that actually,
go
because
for it.
I heard you say at one point that you thought the conceptual framework was based on what we already had.
It's created in the 1930s in the US, right?
Okay, the AASB one, I think, was the 2018 one, which is a bit more recent. But I think that where Christine was coming from, and I really agree with her, is that actually the conceptual framework shouldn't be driven by what we currently do. It should be driven by what we think financial reporting is about.
Mm-hmm.
And therefore, it should be if it's developed properly, you should be capable of dealing with the drones as well as the cars and the, God help us, driverless cars that are coming through. So in practice, there should not be a challenge as the world develops in terms of the conceptual framework. I used to like what David Tweedy always used to say, you know, if you don't like the answer, look at the conceptual framework and see if that needs changing. So but actually, if you get the conceptual framework right in the first place, you should be able to derive the accounting from it for whatever happens. So I worry about the notion that you might have a shifting conceptual framework as things change, or you might ignore it because you've got a completely different version. We'll probably come on to sustainability later.
So what I'm saying is, as a car maker, you should definitely refine your blueprints within your car maker because you're a car maker. But if you want to redefine yourself as a mover maker, including drones and other metro vehicles, then of course blueprints should change because there are no tire elements in drone, don't you think?
Not wanting
Obviously not.
not wanting to pile on there, but I think a discussion's always good. For me, it's in the statement, sometimes we don't know who we are. And I think you're absolutely right. I guess I just take a different view. I think the conceptual framework should help us to work out who we are and then be clear on that, because there's so many of us around the world. And so like Pauline, I think trying to base our why on the what is what's got a lot of other professions, organizations, and as Christine very I think showed in a really visceral way on her slide of the graveyard, has left some standard settings, where they didn't want to be.
Oh, don't get me wrong. I'm a strong believer of conceptual framework and love conceptual framework. And actually, I have to declare myself, I'm an income statement person. I believe in conservatism. And Christine has been writing a big volume book about conceptual framework itself. I heard that she's finishing it next year, June. So I want to use that textbook.
All right, Christine, you wanted to add something more?
Yeah, I just wanted to take a moment to respond to what I've been hearing because I agree with all of the different comments. I mean, I think Pauline started off talking about how it's very hard to make progress on these hard issues because there's such diverse opinions about what the right answer is. And I would say, yeah, that is definitely an aspect of what makes it so hard to solve these unsolvable problems. But when you have a conceptual framework that allows for that debate to happen without providing a clear path, not an answer, but a path, then you get pulled this way, you get pulled that way. You're just always responding to whoever has the loudest voice in the room without having that guiding map to help bolster the confidence of your conviction of the path that you're on. And so that's why we start projects. We run them into a ditch, we desert them, we leave them, new boards come in, they try again, and we go through the whole process again. And so to Anne's point, I agree entirely. The conceptual framework is not intended to give answers. It's just to, like I said, provide us with that path. So let me give you a quick example. Let's say that we could agree on what should be in a liability and what should be in an equity bucket, regardless of what we say the attribute is, regardless of what conceptual framework we use. There are going to be so many decisions that standard setters are going to have to make around the practical application of that. What happens when the attribute changes? So now you're flipping something from a liability to an equity. How should that happen? Should you do that or not? Or back from an equity to a, I mean, there's just so many practical pieces of standard setting that the conceptual framework simply can't answer. And so that's why, it really, if it gave a clear path, it still wouldn't give us the answers. And then the last comment I'll make is just with Amir, that he hits the nail on the head for what my concern is, which is that we need to have clarity for standard setters about why we do what we do. And I'm not saying that the entire current conceptual frameworks are, you know, not useful. There's aspects of them that are useful, but we've got tough problems getting tougher, and we, in my opinion, just need better help to address those through the framework.
Terrific. I might cut off that first question so we can hear a bit more. So first question that's come through that I'll put to the panel, and don't all feel obligated to answer it. I do assure everyone we will have morning tea by 11:15. So I do feel like we could go till dinner time with this. There's a very well informed and opinionated panel here, which is terrific. As a fundamental framework for definitions in the conceptual framework, do we need to go further than valuation and incorporate economic principles, for example, defining assets by reference to defensible property rights? Who wants first go? Go, Anne.
So in the IFRS framework, we define an asset as a present economic resource controlled by the entity as a result of past events. And then we go on to define an economic resource as a right that has a potential to produce economic benefits. And I think that really addresses that question, because we're saying you have to have a right, you have to have a present right, but the right is not the economic benefits. The right is the potential to produce economic benefits in the future. But the thing that you have to have is that right, the capability to get those benefits in the future. And we think about rights very broadly. And I'm not sure if the question was saying, should they be narrowed? But I think our definition captures the idea of needing a right, and separating that idea of the right, which is the present resource, with the potential future economic benefits that are things that are going to happen in the future. And that's helped us a lot in terms of thinking about uncertainty of the future benefits. The future benefits might be uncertain, but you have the right now. The right exists at the moment. So I'm not sure that really answered. I don't know whether that answered the question, but
I think this is actually relevant when you start thinking about intangible assets. And I worry a little bit about making the conceptual framework and the definition of assets. And I have to say, I like that definition of asset. I think making that too constrained makes it much more difficult to recognize how as assets develop, because if I go back to the start, I used to think mostly about tangible assets. Now I think about all sorts of things. And sometimes just sitting there and saying, do you really have a right to that, is a really useful question to have. Defensible property rights, to my mind, feels a little bit more like a sort of potentially a sort of jurisdictional specific issue rather than a global characteristic that we could actually look at. I have to say I've had loads of arguments with clients about whether or not they actually had a right to the asset in the past. I might have used defensible property rights as part of my argumentation, but I wouldn't want it to be the only thing I was looking at. So I think a definition has to be quite general, and actually identify the characteristics that are truly relevant when you're looking at the asset in question. And then you can apply that in specific circumstances much more effectively.
Can I just add one thing that our definition has made me think quite a lot is often the question is not, do I have a right, but what right, exactly what right is it that I have? So in thinking about the asset, what is the asset? And if you have something of value, you almost certainly that's based on some sort of right, and it's identifying what the right you have at the moment is. That is the question that often comes up.
Yeah, I think we need to be even much more ambitious than that in rethinking the concepts. And I'm going to sort of uncouple the balloon a little bit from Earth here and float up, so bear with me. But if you think about digital reporting by way of example, we often think about how that can help us to communicate the information that's currently produced under the current conceptual framework. I sometimes wonder about these issues, the ones that Christine raised, where we've been banging our head against a wall for 80 years or more, whether the scope of digital reporting actually allows us to go back and rethink what's actually possible now in terms of communicating information. And often that is in the areas where it's unclear what the value is. And so the notion that you have to land on a single point value, is that still valid? Is there a possibility with the technology available now to communicate useful information in a way that recognizes that, no, we don't actually have a crystal ball and we can't actually do that?
Next question. What about stewardship and this is in a few parts actually, so I suppose pick what you want to address. But what about stewardship as a second objective of financial reporting? Is it important? And can an internally consistent conceptual framework have two objectives? Christine.
Boom. So they can't have two independent objectives. So stewardship is critically important because if we say that the primary objective is to help an investor determine a resource allocation decisions, a financial capital allocation decision, what they're trying to do is assess the expected return that they're going to get from that investment and whether it's high enough to justify the risk that they're going to bear. And that expected return is going to come from the future cash flows. Now, the financial statements need to provide information to help them assess those cash flows, and whether or not managers are any good or not is a pretty important aspect of assessing those future cash flows. That is why it's so important that the measure of comprehensive income, the measure at the bottom of the accrual basis income statement, provide as clear a signal as possible of the success or failure of the decisions that managers have made in terms of the investments that they have made. So I think that stewardship is very important, but if you put it in as, we have two separable objectives of financial reporting that aren't linked. One is to provide information to forecast cash flows, and another is to assess management, and not only the decisions management made, but the decisions management could have made. Now you're going to you're not going to be able to create a one single conceptual framework. You need to have two.
I'm probably not going to be allowed back into the UK, I've got to say this, because stewardship's always been a bit of a UK obsession, but I absolutely agree with Christine. I think people get confused, I think, about stewardship as being somehow different from looking at future cash flows. I don't think that's the case, and I think that you have to have a coherent perspective when you're looking at accounting. So yes, I mean, obviously investors do care, but it's not the primary function. But I don't have any problem with saying, well, as part of this main objective, you have stewardship underneath. I think that's actually a very clear driver to assessing the cash flows in the future. But I would not want to see it actually added in. As I say, I'll probably get shot when I get back.
Well, let's hope not. And
I was just going to combine everything into the answer that is in our framework, which is we have one objective, which is providing useful information. And as part of providing that useful information, you think about the ability to predict future cash flows, and you also think about how the management of the company is using its resources. So you've got absolutely one objective, but you have stewardship and the projection of future cash flows as equal parts of achieving that single objective.
all right, we have time for one more question. I'm going to exert the chair's prerogative to go a bit beyond that, but we will finish by 11:15. So panelists can see the time. Don't worry about that too much. Don't worry, I'll cut you off. So last question, and I do acknowledge we've received quite a few online that we're not going to be able to get to, unfortunately, but Christine gave you her email address before, so feel free to bombard her. What does the panel think of the applicability and usefulness of the existing conceptual framework for recent developments in sustainability-related financial disclosures? So really easy one to finish off with.
Well,
Han, yep.
the conceptual framework is designed for transaction-based things, and sustainable reporting is about the externality, which has nothing to do with specific events. So the current model cannot address, from my opinion, the sustainable reporting, and there should be a separate conceptual framework. And therefore, I'm not quite sure what the integrated reporting would look like in the future, like in 10 years, or what connectivity can we see in 10 years?
I'd take a slightly different view. I think they need to be consistent, and if we can't work through that, we'll be left in the situation I think that we had in the last question. And in my mind, the stewardship discussion in this context, it seems like a euphemism for saying sometimes, you know, what's going to generate those cash flows and make some money isn't so good for everybody else. And I think we've got to work our way through that question and have a clear and articulate answer, or we will be left into a no one's land as far as the why that underpins everything we do in reporting.
And
Just so from the IFRS Foundation point of view, the Sustainability Board is, you know, the sister board of the International Accounting Standards Board, and the objective of both boards is to provide useful information to investors. It's all part of this providing useful information to investors. And so S1 is very closely based on our conceptual framework. That was how it started. It was taken from our conceptual framework. So we certainly believe in having, you know, consistent conceptual frameworks, or even the same conceptual framework. The two chapters in our conceptual framework at the beginning that talk about general purpose financial reports rather than the material on general purpose financial statements that come later, those two chapters are applicable to the sustainability reporting that the foundation is interested in.
true. Pauline.
I think I understand that S1 was based on the conceptual framework. S1 doesn't feel like a conceptual framework to me. And I think that's partly because of the way it was drafted. My own view is that there does need to be an extension of the conceptual framework. The objective should be the same. You're still trying to look at the same things. You've still got the same user group. I was really pleased that you didn't define a different user group, or the AASB didn't define a different user group. Clearly, a set of financial statements needs to be coherent. And I think there's a serious risk if you depart too far from that those basic fundamental principles, you'll end up with inconsistencies, and the issues that have already been raised on connectivity will get worse. However, I do think there are some specific things around narrative reporting and sustainability reporting where you do need to think about the elements differently. So some of what's in your framework doesn't flow across, but if you start from the same place and develop something that is wider and looks at that wider forward-looking information, then I think you're in a really good place. So I do believe that the IAASB needs to develop a conceptual framework separate from S1.
So when you narrow the scope of sustainability reporting to emissions reporting, like baseline reporting of ISSB S1 and S2, yeah, that's true. But when we think about ESRS and double materiality, it's a whole different game. And what they say about by sustainable reporting, some people, is double materially GRI reporting. So in that regard, slightly different, I think.
We've got 60 seconds left, and I'll give last word to Christine. So
Thank
Christine,
you.
over to you.
So I would be, I think, in the same frame of mind as Pauline, which is that, if you start with the same objective, certain aspects of the conceptual frameworks will be consistent with one another, but the assumptions underpinning a conceptual framework are not just limited to the objective of whatever the reports are. So just as an example, as I look through sort of the underpinning assumptions to the conceptual framework that I was discussing earlier, there's a series of 9 assumptions about the financial reports themselves, which makes sense when we're talking about assets, liabilities, equity, dollars and cents, and numbers that appear in financial statements, like the assumption that there is an economic balance sheet that underpins the practical accounting balance sheet. Well, that assumption doesn't make any sense necessarily for thinking about sustainability reporting. So I guess I would encourage when we start thinking about conceptual frameworks for sustainability reporting, that we go back and think about the underlying assumptions and how that might then cause us to create some principles that are specific to helping those standard setters think through what should be included in sustainability reports. But there should be overlap if the objective is the same.
All right. We might have to pull it up there. Thank you very much. That was a very fluid discussion, and good that a debate was going on. I'm very much looking forward to Christine's book coming out in June. For those of you that have unanswered questions and want to follow up, like we acknowledged before, Christine gave you her email address, and the rest of the panel won't be hard to track down. So, if you feel free to, I'll invite you to go and fill their inboxes with questions on all this. They're obviously very well informed, and lots of well-informed opinions on this matter. So please join me in thanking our panel.